Hello, everyone. Welcome to another Rocket Dollar educational webinar. My name is Brendan Walsh, and the reason we do these is just to make our clients aware of the many different investment opportunities and areas out there. We're going to be talking about a couple hot topics today as far as culturally, but a lot about what the future of work, remote work, office work. That's been a pretty big cultural shift. And a lot of people think of it more in a personal sense, but Phil sees it from much more of a business angle, and how that's changing opportunities out there for both companies and investors. So this is funny. I just did a poll. Where are you working from now? Where are you working from more these days? And it was actually a 50-50 split right now, which,
Perfect.
yeah, a couple years ago, we didn't think that would be. And just for context, Bill, before we get started, I'll tell you Rocket Dollar's work from home story. So this is obviously my home now, but we were fully in the office until 2020. I was flying back from Taiwan and Asia, and I said, "Hey, it seems like there's something pretty serious going on there." So our company had already kind of looked at COVID and everything, and we went fully remote. And but a main reason why was just financial. Our office lease was ending 2 months after I had gotten back, and really it was perfect timing for us in the pandemic. So we are fully remote for almost 2 to 3 years, and then we've had a pretty serious commitment to a local co-working space where if there's big customer issues or initiatives that we need to work on, we're all there working in office in person. Almost all of us are in Texas. We have a few people out of state, and we'll actually fly them all in during that same week stretch. So, Phil, I'd love to hear a little bit about you and your background, and then we'll get into our content today.
Totally. And so excited to be here, Brendan. I've been looking forward to this. Appreciate you and the Rocket Dollar team. Your story is so common right now. Pre-COVID, there's so many companies that were fully in the office, then went fully remote, and then had to find a happy medium of what type of hybrid works. So appreciate your story, and I hear it a lot. So for everyone that's dialed in here today, my name is Phil Leslie. I'm the managing partner of a group called Workbox Ventures. My career has been, I started out my career at Microsoft in the Seattle area, and then grew and sold 2 startups that, even though we didn't talk about the term future of work back then, both of the startups that I grew and exited were really what I now think of as being future of work type of startups. So the first one was the first mobile app for turning pictures of receipts into expense reports. That's been a few years. And then the second one was an early entrant in the remote job interviewing space using video interviews. After I grew and sold both of those companies, I switched to the investment side, first at a firm that has over 100 portfolio companies, and now with Workbox Ventures, which is a part of Workbox.
Great. Yeah. And so we're going to have some slides and content and some data that Phil's going to show today. Please feel free to pop questions at any time, and if you're in the audience. We'll make sure we get a pause, and feel free to share your own stories as well. How are things changing for your own business or yourself as an employee?
Great. Well, let's hop right into it. So I gave those couple examples of times in my past where I was starting a company that was challenging the way that people work, the workflows, the traditions, and trying to modernize those based on the latest technology. We just happen to be at a moment in time right now where there's a whole lot to challenge as most teams kind of settle in and figure out what the right hybrid work style and culture is for their company. And so that made it a really great time to launch a venture capital fund focused on backing companies that are building interesting future of work solutions that help all of these hybrid and distributed teams succeed. So that's kind of what we're doing at Workbox Ventures. We are a part of a larger organization called Workbox. I think many that are dialed in today have been to at least one of our Workbox locations across the country. We're now at over 600 members. We've got 7 locations, many, many more to come. So if we're not yet in your city, we hope to be there soon. And for us, yes, we have excellent workspaces. You come to our spaces, you feel comfortable, you feel at home, you feel like you have everything you need to do, everything you need to succeed in your workday. But it's a lot more than that. It's also our business services arm that brings in different investment partners, mentors, advisors, educational sessions, and other growth resources. And then also the venture fund that we'll talk a little bit about today in this session. So think of us as a great place to not just come in and have your work day, but to really engage in the growth of your company and tap into resources that we bring into the spaces and bring to you virtually. I'll just start by giving a little bit of a backdrop of the team behind Workbox Ventures. So, we've got 3 very experienced team members that are general partners in the fund. This is not corporate venture capital. This is not a company that takes capital off of their balance sheet and then goes in and invests around specific strategic interests that may or may not be a strong financial return from an IRR perspective. It's not that. This is a limited partner backed venture fund that gets the benefit of being able to tap into the unique insights that we have at Workbox because we are surrounded by companies that are settling into their new hybrid and distributed work style. So the benefit of being able to have that whole backdrop of all the insights that we get from our ecosystem, but to be able to bring that value to the limited partners in the fund for the purpose of strong investment returns, that's what really drives us. And to support that effort, yes, we have our 3 general partners, myself, John Wallace, and Kyle O'Connor, but we also have just an extraordinary advisory board. It'd be hard to count up how many investments this group has been responsible for across their careers, but well into the hundreds in terms of seed, A, and beyond venture investments. So such a pleasure to be backed by this group of advisors and to be alongside these excellent general partners in Workbox Ventures. That's just a quick snapshot into me, into the team, into our advisors. But to kind of get into our session for today, there's 3 things that we plan to talk about. First, just diving into what venture capital asset class looks like in the current market conditions. I think probably everyone on the session today has seen headlines over the past few years about some of the ups and downs that have happened in venture capital. And I want to really bring you kind of a up to current, a present day update on the state of the venture capital asset class and what that kind of means for all of us that are doing interesting work in it. Second, let's talk a little bit about this disruption around future of work, the challenges and the opportunities that come with it as we all figure out how to do hybrid and distributed. And third, I'll loop back around and tie in exactly how Workbox Ventures benefits from both the current market conditions and the future of work disruption and opportunity. I'm glad to take questions throughout. I think Brendan will sort of manage the process of fielding your questions as we go, and we're glad to chat through them.
Yeah, and I think this topic is really relatable too. I mean, almost every single one of our clients, unless they're retired, we actually have a lot more people in their prime earning years here at Rocket Dollar than tail end of retirement. How's your business changed? How has your team's been disrupted? What have everyone knows like Zoom and stuff like that, but there's a lot more companies rising and falling at this time in the software as a service business, and also real estate. Things are changing quickly.
Yeah, I appreciate that. I agree. Almost everyone has their story of how over the past few years work has changed for them. And I'll often ask the question after hearing their story, hey, is it all kind of settled? Is it all solved? Do you feel like you've got the permanent great solution for how your culture and your processes and your workflows and traditions are going to work? And most people say they're still kind of in the thick of figuring out how things will work in the long term. And so, yeah, I really enjoy hearing the stories of people about how work has evolved. And that's a big part of why we're here doing this.
Yeah, we'll share one thing that's still not solved at Rocket Dollar. So I used to run our intern program. So I still do. But the problem is we have to spin it down a little bit because in the office, having two college sophomores or seniors, the seniors can pick up stuff faster than sophomores. That was pretty easy to just have them sit next to me and osmosis literally everything I was doing all day, and then, help them on a task and then be focused. And that became so much harder. We transitioned just fine. But we actually had to go back in the office to train certain people because it just got exhausting to spend 8, 9 hours on, with our youngest employee. I literally had Google Meet open with him for just 8 hours a day. We'd have cameras off and we'd take breaks, but just he needed to be there to ask questions. And we had to stop our internship program because we just couldn't train. We usually take them in from Texas universities, smart kids, but we couldn't train them fast enough to satisfy, taking away one of our senior staff members to bring on that intern.
Brendan, being on a video feed for 8 hours straight sounds like torture. So I know that's not the way of the future, but we get a little bit into what might be.
All right, I'll let you jump in here.
All right, let's do a quick market conditions update for venture capital. So fundamentally, what's happening right now is that the demand for capital far outstrips the supply. So in a position like I'm in, I'm hearing from founders every day, all day, telling me about the seed round they're raising, the Series A round they're raising. And I'm asking questions around what their progress is towards close. Have they found a lead investor? What kind of terms are starting to make sense to everyone involved? And more often than not, I'm finding that those founders are in a spot where, even though they may have an excellent business, they're really struggling to find A, the right lead investor, but B, the right investors to fill out the round beyond that. And that capital demand to supply ratio is way out of step with anything that we've seen in the past almost 15 years. So that's a lot of the things that I'll share around the market conditions update stem from this as a root cause, the gap between supply and demand of capital. Right now, if you focus just on seed round, just as an example, and we could look at any stage. So venture-backed companies, a lot of them start with maybe a pre-seed financing, and perhaps that includes mostly friends and family. Then maybe they'll move to a seed round and then a Series A, a Series B, and beyond. But I think seed is really interesting to look at because those are kind of the companies that you look at over that you say, the ones that are raising a seed round right now are the ones that will be raising an A round a couple of years from now, a B round a little bit after that, et cetera. So it's an interesting snapshot into founders that are making good commercial progress, successfully getting backed, even in these unusual times. And what we're seeing in that segment of the market is that deal volume is down 50% from peak. So it really maps perfectly with what we just talked about as far as the mismatch between the supply of capital and the demand for capital. The deal volume is way down. The valuations are down too, and that's helpful. But I will say that in times like this, it's the ventures that are making the absolute best, most terrific progress that actually get funded. And so that's why you see deal volume down, valuations down some, but deal volume down more substantially. It's absolutely an investor's market right now. It's true that there are plenty of down rounds right now, more than there have been historically in the last several years. And I think if you look at some of the headlines about venture capital 2 years ago, there were maybe some rounds that made headlines at very large dollar figures, very large valuations, very large capital commitments, et cetera, that are now having to raise a down round, conserving capital between rounds, and maybe raising bridge rounds to find their way through. And again, this all kind of relates to that core aspect of the market right now, where there are so many more founders raising than there are investor dollars to fulfill those rounds. Tough time to be an entrepreneur raising, an extraordinary time to be an investor deploying.
Yeah, and I don't think we'll see a lot of relief, unfortunately, in that dynamic for the entrepreneurs. It's really gonna inflation being relatively persistent and interest rates being really high comparatively to what we're used to in the last 10, 15 years. That dynamic might keep going for the foreseeable future.
Yeah, I'm not going to go on the record with a numeric prediction here, but I will say when you look at the number of rounds of seed rounds that successfully closed the prior quarter, Q1 versus Q2, that's starting to stabilize. Granted, significantly off of the highs. Many of the metrics that we see around seed stage financing are starting to stabilize. Maybe the nose isn't yet up on looking at it and saying, oh, gee, there's going to be a lot more seed rounds closed next quarter than last. But the stability is there in a way where people are no longer looking at this market and saying, okay, in Q3, are we expecting seed rounds to split in half again and to continue to be on a downslope? I'm not hearing much concern around that. I feel like we're now at a point where there's some stability.
Yeah, and that might mean, there might have been some pretenders in the venture side that have been completely washed out now, and they've kind of turned their tail. They're gone. Their capital is also gone, but they're probably not re-entering the market. And, the stronger venture and more well-capitalized are helping to shore up that gap.
Yeah, you said it well. I'll say that we try to be a great student of history when you look back at other times where there's been a difficult economic climate and you think about where people go to find interesting returns on investment. And we like what we see and what we learn from history in terms of the way that venture capital performs during these downturns. And it's a little bit of what you said, Brendan, where the founders that are actually getting into the game now and the investors that are actually deploying capital now, they're not tourists. Nobody starts a company right now for the prestige or the excitement of being a founder. They started because they genuinely or honestly believe in it and are going to pursue growth. So it's in these tough economic times that the tourists kind of disappear and people that are running on strong fundamentals, both from the operator and founder side and from the investor side, stick around. And historically, that's worked out very well for all involved. So that's a little bit of a quantitative look on market conditions, but I'll also just share in these types of times, venture capital firms also need to kind of refocus on where the venture capital asset class is the most useful and valuable for driving innovation and value. And sometimes firms stray from that when capital is easier to find, when the economic conditions are dramatically better. But now's the time to return to fundamentals. And the strongest case, the place where venture capital can make a huge difference and get terrific returns is when they invest in industries where the status quo hasn't been challenged in a long time, cases where the incumbents serving a particular market aren't adapting to customer needs, as a perfect corollary to what we're seeing in hybrid and distributed work. The types of business workflows that used to work pre-COVID that relied on people all being in the same office, getting together in person all the time, 5 days a week, 10 hours a day, et cetera. Anyone that hasn't adapted their software solution to work really well for hybrid and distributed teams just is not serving their customers well. So the strongest case is all around these situations where the market demand is increasing, customers have needs that aren't being met by incumbents, the status quo hasn't been challenged in a meaningful way by outsiders, and there's disruptions in the industry. The weakest case, the place where venture capital has a lot less to add, are cases where the demand in an industry is shrinking, or there's a gigantic regulatory or IP moat that prevents innovation, or in steady state industries where customers are already delighted with what they have and have their needs met. So it's a return to fundamentals in this particular era for venture capital. Brendan, anything to add there before we flip to the next section?
No, let's keep rolling.
All right. Okay, well, let's talk very specifically, not just in this broad venture capital asset class, but let's zoom in specifically to future of work and some of the trends that we're seeing that give rise to interesting economic opportunities for investment. I'll go through a few trends just to kind of get the creative juices flowing. So trend number one, this almost isn't even controversial anymore. Hybrid and distributed work is here to stay. There's very few companies that are 100% every day full in person. And there's very few companies that are absolutely 100% remote, never want to see each other, never want to gather, never want to get together in person with customers or with each other. That middle section that's all hybrid and distributed is here to stay, and that's kind of what has prevailed. Unfortunately, pre-pandemic, 75% of employees had never worked from home. So if the norm now is hybrid and distributed, and the pre-existing conditions were that most employees hadn't ever done that, that's a challenge. 66% of companies leverage hybrid work now. There's definitely industries that you could look at and say, hey, 95% of companies in this industry leverage hybrid work. So this is kind of a middle ground statistic. There's industries where it's a lot higher figure. But you ask teams and employees, do they have the collaboration tools that they need to work with their team in this hybrid and distributed environment? And the answer is that a lot don't. Across the full set of experiences that a team has together, adding a new open position, hiring for that position, onboarding, doing learning and development, hey, having an intern program, like Brendan said, doing performance management, doing offboarding. Teams do not have the collaboration tools that they need to feel confident that they can do all of that, do it well, and have strong team camaraderie through the ups and downs. So that's future of work trend number one. Trend number two, and again, maybe this isn't even controversial anymore. We create and consume information faster than we ever have before in the history of the planet. But because of that, because of the very fact that we create and consume information faster than ever, the bottleneck that prevents us from getting to insight and action is more severe than it ever has been before. It's 231 million emails sent per minute, 1.1 billion websites on the internet, 1.8 billion monthly visits to ChatGPT. There's just a mountain of information that's growing by the day, growing by the minute, that we're desperately trying to consume, generate insight, and take action on. And without a whole new set of tooling and a whole new set of traditions, we'll fail to make the smartest decisions that could be made based on the vast amounts of information that are out there. Future of work, trend number three. So, and this one's maybe a little bit of a different angle than the prior two. The prior two talked about what our experience is like as team members, as employees, working together with colleagues. This one's about kind of the demand signals that we see from companies really trying to do something to serve their teams, serve their employees by aggressively adopting new technology to try to meet those needs. So the market for work technology is larger than it's ever been and continuing to accelerate. And startups are definitely leading the way because they're the nimble ones that are able to turn on a dime and adapt to the new hybrid and distributed traditions in a way that large organizations struggle to do. 4.4 trillion spent on IT in 2022. Average enterprise relies on 130 SaaS apps. I actually argue that might be an understatement. I bet you there's more in those organizations that IT might not know about. And as of June of this year, there were 1,200 active unicorns. So you can see kind of this trend towards people desperately trying to upgrade the operating system of their business to adapt to these new needs and willingly deploying capital to acquire SaaS solutions or other types of solutions to help empower their teams. But we're still in this messy period where we're trying to adjust to all these new traditions in a very quick time frame, but willing to spend to do it.
Yeah, I mean,
yeah, go ahead.
we had a question come in, Phil. So this is more of a retirement question, but I think it's a good time to bring it up. Ashish asks, what's the advantage of investing in venture capital via a retirement account, especially when you can't capture the tax benefits of QSBS? And Ashish, thank you for making me Google. I had to make sure my tax info was correct. Most of that kind of relies around capital gains, and basically helping you avoid capital gains tax. So that does seem like a great couple benefits, but basically in a retirement account, you're pretty much always shielded from capital gains. So it seems like some startup venture investments could hit that jackpot and get like a really nice tax write-off. But I think the biggest one that I saw is you must hold the shares for 5 years. So we have clients that will hold shares for much shorter than that. And there's also an exception for you have to get the original issue of shares, not shares on any secondary market. So there's high competition for a certain venture deal or shares, and you acquire that for someone else, you might not be able to get that exemption. So in a traditional or Roth IRA, you're pretty much always going to be exempt from the capital gains. And if you did it in the Roth, you might have a little less going in, but it's completely tax-free as long as that stays in the IRA for 5 years. You can also reinvest that shorter than 5 years. So if you have a big gain, you can reinvest that in 3 years, put it in something else, and at the 5-year ticker of the original, you can access those funds. So I'd say you can access the funds a bit quicker, and you can get even more capital gains exemptions from doing this in a traditional Roth IRA. All right, so back to your topic at hand here. We got a couple trends. Or any comments on that, doing this through an IRA?
No, I really appreciate the question, and Brendan, thanks for kind of elaborating on it on that topic here. I think that's highly relevant. I will say on the topic of secondary issuances, since you mentioned it, there are definitely people out there that right now are saying, okay, even though I wasn't initially in this venture capital round, can I acquire shares in it? That's not us. That's not us. We're not looking for companies that raised around 3 years ago with someone else where we buy out those shares. We're looking at generally innovators that are much newer than that because they're taking advantage of the change in market for hybrid and distributed work technologies and are raising a seed round or a Series A round, and we're acquiring our share directly in that round.
Yeah, a lot of that secondary share stuff tends to happen in, I think, the 2 years before pre-IPO, where a lot of the employees, they have not been acquired by some megacorp, and they're just really getting antsy to get some share liquidity. So liquidity is usually extremely low in the first couple of years. I've talked to investors that struggle with it. You basically have to go to the other people in the round if you want to offload shares or the company itself. So these are longer share hold times. Most people should basically expect to never play the secondary market for a venture deal like this.
I think that's right.
And Phil, those trends that were changing, I think you're saying they're not controversial anymore. I think it was very controversial still just 2 years ago. There were many mayors of big cities, mostly because they taxed both the employees through sales tax or the leases or whatever. There's a lot of tax inflows that's coming in to those revenues. There was a lot of pushback, and I think they pretty much kind of lost that fight. They can't really force companies to bring people in. There has been quite a few companies pulling people back into the office, away from hybrid, away from work from home. But from our opinion, just when we chit chat at Rocket Dollar, it frankly looks more like a mass layoff than a refusal to allow people to work from home. It's almost like a stealthy staff reduction if they need to shed. If a company needs to shed 20% of staff very quickly, get everyone to come back to the office, shed a bunch of them, and then, okay, maybe work from home is back, 4 to 6 months later. It's really
There's definitely plenty of debate around that. I'll weigh in on what you said earlier about what the status quo was before and how many people, if we were doing this 2 years ago, would have said, no, hybrid's not going to be a thing. That's not going to be the way it is. Or any of these trends that I'm raising that would have said, no, that's not going to be a thing. AI is not going to be important. We're doing fine without it. I think it kind of reminds me of a great book called The Innovator's Dilemma that kind of talks about how people that have a huge economic interest in the status quo of the way that business is done those are the ones that will fight the very hardest to keep that status quo as is. So all kinds of stakeholders that were kind of benefiting from the way that work occurred pre-COVID, that were hanging on to that, hoping that we get back to exactly the way it was. And it's just that's just not the future. So that's kind of by definition the reason why startups succeed in this era. They don't have the baggage of having economic interests that rely on the old status quos. They're intentionally trying to meet customer needs, even if that disrupts the way that business used to be done. So yeah, I'll just say it's a classic case of the innovator's dilemma.
Mhm. And, for these younger, more nimble startups, what would you say the end game here is? Is that becoming a, productive SaaS, software as a service business, or would the end game really to try to sell to a Salesforce, a Microsoft, maybe an Oracle? I'm just trying to think of who really sells
Sure.
a lot of office-based, work-based software.
Well, let me start a little closer to what's going on in these startups while they're raising their seed rounds, and then I'll get to kind of the outcome that we hear founders talk about more than anything else. So around these seed rounds, right now we're seeing a huge amount of commercial progress that these founders are able to report out to us. They're able to tell us, they've got this Fortune 500 as a client, and that one, and this other one, and this pilot with this multinational organization, and this more experimental deal with this other one. And so the commercial progress that we're seeing is just extraordinary compared to what would have been the case for a seed round 2 years ago. The fact that that's how these companies are getting set up right now, and that they're so focused on actually making revenue, commercial progress with real customers, suggests to me that these founders are on the right track when they think about eventually getting scooped up by a strategic acquirer. So, you mentioned a couple of big companies there. If you're an early stage company in a sales enablement business, and you have outsized commercial progress, a large existing incumbent starts noticing you, starts hearing from customers that they're also using this tiny startup solution, and they run into it more and more. There is fundamental reasons why that incumbent will look and see if they should acquire that startup that's starting to kind of impede in their market. So absolutely, these founders are generally working very hard to get to a point where some strategic acquirer approaches them and says, hey, let's talk about maybe combining forces here.
And with that software as a service model, I think that, acquisition is almost easier. Those companies are very used to folding 40, 100, 500 person teams right into their own corporations and keeping like a relatively quick acquisition path compared to some other, businesses that maybe are frankly much more physical in nature. It might be harder to just like absorb some manufacturing operations like that.
No, I agree. A typical B2B software as a service company that's got a subscriber base that just takes another stair step up, and hey, instead of the $1 million of ARR that we had as of last month, now we're ticked up to 1.15 million of ARR. Next month we're at 1.3 million or 1.4 million or 1.5. These are businesses that they build such a compelling track record where you look at the customer history and say, hey, you're winning 95% of your renewals on a logo basis, and on a dollars basis, you're renewing 120%, 130% of the prior contract value. Hey, it's pretty easy to see that this revenue stream is going to continue to grow. So it's not asking acquirers to have such a leap of faith around, loving a founder and believing that founder has the sway and the persuasion ability to find new revenue sources and new ways of doing business every quarter. They're looking at it from a more measured, historic approach in terms of looking at the revenue stream. So software as a services businesses are just so effective in times like this when acquirers are figuring out what acquisitions they might do to layer on additional revenue and strategic value.
And I think the cross-selling is also easy for those bigger organizations to immediately visualize. Not only are they maybe taking out a competitor that might be a little bit of a threat, but then their leads lists are generally thousands to millions more organizations bigger.
Absolutely. You talk to a lot of strategic acquirers, and they kind of think around, how do we do a deal where 1 + 1 = 3? And by that, I mean that they acquire a company where it's got this solution that they've got 1,000 customers on, but the acquirer has 50,000 customers. And hey, if we acquire this company, maybe we can sell that solution to the other 49,000 of our customers, and get a ton of new revenue to layer on this year. That's absolutely a common thesis for acquisition.
And we can move on, but I'm just curious, is a lot of the stuff that, you know, in the venture space, is it more of that software as a service, or is there more like physical real estate type stuff that comes across your desk sometimes in this area?
Well, a lot comes across my desk right now because the gap between capital supply and demand is so wide that founders are asking any investor possible to take a look at their deal. But what we're interested in primarily are B2B software as a service ventures that help hybrid and distributed teams excel.
Mm-hmm.
That's what we're looking for.
Always good to have a focus. All right, I'll let you continue here.
All right, well, kind of the third part of our session today is to talk about how Workbox Ventures specifically benefits from the current market conditions and the future of work disruptions. Let's get into that a little bit. So, you know, I mentioned at the top that this is not a corporate venture capital arm where we're investing in deals just to fit the strategy of our parent organization. This is a venture capital fund where we're investing for strong returns, but using the insights that we get because of the deep reach that we have into the hybrid and distributed world. So let me just share a little bit about kind of the insight that we tap into as we look at the future of workspace. We have a pre-seed accelerator program that's 100% focused on future of work companies that are earlier stage than what the fund will be able to invest in. So think about it as this early look that we get into all these companies that as they grow, will grow to a stage where we want to look at them closely as an investment opportunity. That pre-seed accelerator program has graduated 68 founders so far. It's got 50 mentors, 40 other capital partners that we involve as we help these entrepreneurs grow. And I think tomorrow we're announcing our latest accelerator class, which is another 9 really terrific future of work companies that are with us over the next few months for the accelerator program.
And like you said, in this environment, they're probably all pretty tenacious. There's not any someone just waltzing in to figure out what they want to do at this point.
There's a lot less of selling the dream and a lot more of telling us which customers they won in the last month and what investor meetings they had and what they built on their product last week. There's so much of this practical, real progress, and that's great. That's what we want to see.
Yeah, and we've always seen a difference. I mean, I moved from Chicago. There was that was more present in Chicago, just generally. The Midwest VCs, they want to hear numbers. They do smaller deals, and they want very realistic stuff. And if you need to dream big, you always need to go out to New York or San Francisco, and that's where the bigger money comes in. Maybe sometimes in a later round for some of these people.
We're happy for people to dream big, but their execution progress is crucial to us. Yeah. It can't be just a dream. So, and I'll kind of add a little bit more about how we scrutinize that. So, you know, I mentioned here that we have this proprietary diligence advantage. So the 600 members that we have across our Workbox locations, with a lot more locations and members to come over the next years, a lot of the companies that are involved in our accelerator program and that we're looking at for the venture fund are ones where their exact ideal customer profile is the typical Workbox member, a team that's hybrid, that's distributed, that's in growth mode. And so we've got kind of this laboratory behind us where we can ask members, either in a member-wide survey or more casual interactions, hey, what is it that you're doing in learning and development that's working right now, that's not working? What are the challenges? And we can line that up with what we're hearing from startups that are asking to get admission into our accelerator or to be looked at for the venture fund. That's a huge advantage for us.
And just so everyone's clear, you have, the venture arm, which, has some presence in all of your office space, but then there's also just frankly co-working, individual employees and small companies, big and small, using your space.
That's right. That's right. That's right. And we would love nothing more than to have investment opportunities that the fund pursues, where members at Workbox have said, hey, this is actually exactly what I need to do learning and development with my hybrid and distributed team. So it's an advantage that we have with kind of really living with these companies that are in all of our spaces and learning from them about what works and what doesn't. I don't want to go too long on this, but I'll just say now is a great time for us in the co-working business. So our growing geographic reach, as we continue to expand to new locations. Recently, we opened a Minneapolis location, a Salt Lake City location, a Columbus, Ohio location. The growth will continue on that front. So every time that our co-working geographic reach improves, that also improves deal flow for the fund. It improves the competitive advantage in terms of involving members and asking them what the challenges and opportunities are in hybrid work for them. And so it's all tailwind for us. I'm not sure that we have time for me to go through every little bit of this, but hopefully that gives you some sense for how Workbox Ventures has an advantage by being part of Workbox.
Great. Well, thank you, Phil. And then
I'll be really quick here on a couple tail end thoughts. Brendan, I know we want to leave a couple minutes for questions. I can wrap up fairly quick here.
Okay.
So I mentioned this earlier, that this employee life cycle that we're all going through, figuring out how to do all of these processes in hybrid and distributed teams, that's what we're learning a ton about from our members, and therefore have an unusual advantage in evaluating investment opportunities. And I'll give you this is kind of a deeper look into some of the specific trends that we're looking at across HR tech, prop tech, and fintech that are all areas that have been disrupted through the transition to hybrid and distributed. So hopefully that gives everyone here a sense for why these disruptions in the way we work create such interesting investment opportunities, and B, why we've chosen to set up a fund as part of Workbox, going after this specific set of challenges with the unique advantages that we have behind us. I'm always glad to chat. Anyone that wants to learn more about Workbox Ventures, I'm very easy to find on LinkedIn. Feel free to drop me a note directly if you'd like, but I'll always love getting to know members of the Rocket Dollar community more.
All right, and we are open for questions, so feel free to throw any at us. And do you want to just go back to that prop tech, the HR's slide?
Sure. Yeah, sure.
All right, yeah, these. So I think we talked a little bit already about like HR tech and software as a service, and prop tech, that's real estate, really. I mean, real estate has been quite a absolutely ancient industry for quite a while. I think the last cycle, a few companies thought they were going to immediately crack the nut on more residential real estate, but then like office real estate is a whole other nut that still behind the times, and finally just modernized.
Yeah. I mean, think about everything that needs to happen now. There may be offices where you need a little bit more automation than you used to have. Could be anything from making the visitor check-in more automated, to doing things like being able to understand which parts of the office get a ton of use and which parts don't, so that you're doing so that you're being savvy about figuring out how to manage what space you need and for what. There's workplace discovery, where you land for a meeting in Houston, you don't happen to have an office there, you'd really rather not meet at a coffee shop. Where do you go? Can you book it now? Can you head right there and walk in and show a QR code, or what's the fastest path? So there is a prop tech angle to some of this, but it all centers around hybrid and distributed.
Mm-hmm. Yeah, and then fintech, we're obviously extremely familiar with that. We, all of our customers go through KYC and AML, and if there's ever a complaint, why is this taking so long? It's honestly probably usually one of those. It's a lot of sensitive customer information, and the government wants quite a few checks on that.
I think on the fintech front, there's a very high level of anxiety around, you've got maybe a CFO that happens to be working from home today, and there's a large transaction that needs to occur, or there's some very sensitive financial analysis going on, and a distributed team is all contributing to it. So how to do those kinds of finance-centric activities in a way that you have confidence around the security of the workflow, I think there is much more to solve on that front.
Yeah, and there are financial offices where no outsider is literally allowed to touch a single computer, So the sensitivity of some things that some people are dealing with. So we had another question come in from Ashish. So can you provide some details on the raise? What's the average duration before an investment exits? There's a second half to the question, but I might pause there for right now.
Yeah. I'll talk in some broad industry terms. More specific follow-ups are probably more appropriate for a follow-on. There's some regulatory things around what we can and can't cover today. But I will say, when you look at a venture fund that's structured as a 10-year fund, the concept there is that the deployment of capital, all the way through getting those ventures to the right follow-on financing, all the way through getting them to the point where there's acquirers that are knocking on the door. The desire is for the business of the fund to be primarily wrapped up within that 10-year horizon. So it's not, venture capital isn't something where you put in capital today and expect for a 10x to come back 12 months from now. It takes a little more time than that. But that's kind of the way that fund structures on a decade-long horizon are set up.
All right. And there's some other things, Ashish. We'll have Phil reach out to you after. If it's okay, I'll share your email and they can follow up on some more of those. All right. Any other questions, or we'll close out here today? All right. Thank you so much, Phil. I appreciate you coming by.
Thank you.
Stop by here with Rocket Dollar.
Excellent.
As always, if you need a self-directed IRA or a solo 401k or any questions at all, just give us or our support team a reach out. And we also have referral codes, that we can hand out give a discount for this or your personal referral codes. All right. Thank you, Phil.
Thank you.